Welcome back to the channel. Today we're diving into the economics of Radiant, also known as RXD, a cryptocurrency that's been making waves of how it combines Bitcoin's battle-tested security model with modern DeFi ambitions. But what really sets Radiant apart is its economic design, its halving schedule, inflation curve, and how it's creating scarcity faster than Bitcoin. If you've ever wondered whether RXD could become the next big proof-of-work contender, this breakdown's for you. Now, when we talk about economics in crypto, a lot of people immediately think of price action. Charts going up or down, market caps, and so on. But what really gives a digital asset its staying power is the underlying supply mechanics. And that's exactly where Radiant is interesting, because while it borrows from Bitcoin, it compresses the entire scarcity timeline into a much shorter window. So let's start with the basics. Radiant has a fixed maximum supply, just like Bitcoin, but instead of 21 million coins, RXD is capped at 21 billion. That sounds like a huge number, but keep in mind, it's really just a different decimal design. The important part is that the supply is capped, meaning it can't be endlessly inflated like flat currency. Here's where things get fascinating. Radiant's block time is 5 minutes instead of Bitcoin's 10, and halving happens every 210,000 blocks, which translates to every 2 years instead of every 4. So while Bitcoin stretches its supply emission across more than a century, Radiant squeezes that same model into just a few decades. When Radiant launched in 2022, the block reward was 50,000 coins. The first halving hit in 2024, cutting it to 25,000. The next halving will arrive in 2026, where it drops again to 12,500. This cycle will keep going all the way up until 2108, when rewards fall below a single photon, which is the smallest individual unit of RXD, 100 millionth of a coin. Now, what this does is front-load the supply. Most of RXD will actually be mined within the first 15 years. Compare that to Bitcoin, where the majority of coins are spread across the first 30 to 40 years. So, Radiant isn't just copying Bitcoin's scarcity model, it's accelerating it. As of mid-2025, we've already hit 13.56 billion coins in circulation. That's about 64.6% of the total cap. Inflation, which used to run about 20% in the early days, is already trending downward. By the next halving of 2026, new issuance will shrink even more, and by 2028, we'll likely see single-digit annual inflation. Radiant is literally walking Bitcoin's path to scarcity, but at double speed. Of course, we can't talk about supply without looking at mining, because that's what secures the network. Radiant runs on the SHA-512-256D proof-of-work algorithm. It started out as a GPU-friendly coin, which made it appealing for smaller miners running NVIDIA and AMD cards. But as with every profitable chain, ASICs have entered the scene. Today, Radiant's hash rate has exploded past 3 petahash per second. Difficulty is now over 172 million, and the average block time stays steady at around 5 minutes. With the release of powerful ASIC rigs like the Dragon Ball A11 and the Ice River RXZero, mining efficiency has gone way up. That means the network is more secure, but it also means hobby miners are slowly being priced out. This is a double-edged sword. On the one hand, industrial-scale mining brings predictability and resilience to the network just like Bitcoin. On the other, it risks concentrating hash power in fewer hands, which naturally sparks debates about decentralization. Still, from a purely technical perspective, this shift still makes RXD harder to attack, and that's a critical factor if it wants to become a serious blockchain for serious applications. So, where does this leave us in terms of scarcity? Based on the emission curve, over 90% of RXD's total supply will be mined by 2030. That's just 5 years away. After that, annual inflation will be negligible, approaching zero. For holders, this is a clear signal. The earlier you get in, the more you benefit from a rapidly decreasing issuance schedule. Let's stack RXD against some other proof-of-work coins. Bitcoin is the obvious comparison, the original digital gold. Litecoin has also capped supply and halving mechanics, but Radiant pushes scarcity faster, essentially trying to reach maturity sooner. It's a bold design choice, the idea that value discovery and adoption should happen earlier rather than be stretched over 100 years. So, what does all this mean for the different players in Radiant's ecosystem? If you're a holder, RXD is shaping up as a deflationary asset that rewards patience. The shrinking block rewards means that your share of the total supply becomes more valuable over time, especially once the market recognizes the supply crunch. If you're a miner, things are getting tougher. The early GPU mining days are gone, and profitability now favors those with ASICs, cheap power, and industrial setups. It's still viable, but the competition is brutal and margins are shrinking. And if you're a developer or builder, Radiant offers a compelling platform. It combines UTXO-based smart contracts with low fees and strong security that makes it attractive for peer-to-peer apps, escrow systems, or even Bitcoin-native DeFi services. The economic design ensures the platform won't be weighed down by runaway inflation, which is a huge plus for long-term stability. At the end of the day, Radiant is a bold economic experiment. It compresses Bitcoin's century-long scarcity arc into a few decades, and it's already more than halfway there with over 13.5 billion coins mined. The big question is whether the utility and adoption will keep pace with its accelerated timeline. If it does, RXD has the potential to stand out as one of the most thoughtfully designed proof-of-work assets of its generation. So, is Radiant the next big thing in crypto economics, or just a fast-track version of Bitcoin that might burn out too quickly? Only time will tell, but one thing is clear. Scarcity is coming fast, and those who understand it early could have a serious advantage.